Good afternoon. Welcome to today's Money Counts webinar, and thanks so much for tuning in during spring break. We really appreciate it. My name is Allie Smith. I'm a specialist here at Penn State's Sokolov-Miller Family Financial and Life Skills Center. I lead the one-on-one financial coaching program here at the center, and I also host this regular webinar series where we cover a new financial literacy topic every other week. Today we're talking about saving and investing, and I'm really excited to talk about saving and investing today because this is one of my favorite things to talk about. We also tend to get a lot of questions about saving and investing in the one-on-one financial coaching appointment. So we know people have questions about saving and investing. I also have my colleague Sarah here to help me out. She'll be moderating the chat and posting some helpful links and resources in there throughout today's webinar. So be on the lookout for those extra tidbits of information coming through the chat today. As you have questions, you can ask them in the chat or in the Q&A. Sarah and I will both be looking at the chat throughout the webinar, and we'll check out the Q&A at the end. The Q&A feature does allow you to ask questions anonymously if you'd like to take advantage of that. If you are attending from Smeal's Ethical Leadership Challenge, we do have a QR code for you, and we'll share that at the end of today's webinar. All right, so with housekeeping items out of the way here, before we dive into saving and investing, I just want to take a quick minute, as always, to get to know who is in our room with us today. I'm going to share out a poll here. Okay, you should be seeing a poll asking, what's your affiliation with Penn State? I'll give you guys a minute to answer that. So far, it's looking like we have a good mix. I'm surprised to see some students tuning in during spring break, but definitely appreciate that. We also have some alumni, a lot of staff here today, some faculty, and Penn State parents. Awesome. Welcome, everyone. Thank you for being here. I really hope that you get some value out of today's webinar and walk away feeling more comfortable with saving and investing. So before we dive in, I actually want to turn it back over to you all to kind of get to know how you feel about investing and money in general. So I'll give you a chance to answer one, two, or all three of these questions in the chat if you want to. So you can tell us how you feel about money, something really fun that you've been saving for, or your thoughts or feelings about investing. So I'll just give you a few seconds to kind of think about this. I'd love to hear some thoughts from the group on how we're kind of entering this conversation on saving and investing. Investing is mysterious. Okay. Confusing. We're saving for retirement. That's great news. Investing is important, but a bit overwhelming. I agree. Investing is very important, but it doesn't need to be overwhelming. We'll hopefully demystify investing a little bit today. Saving for a trip to Iceland. That is very exciting. That's fun too. Okay. So as you're thinking about this, feel free to continue dropping your thoughts and feelings in the chat here. But I do want to say, for anyone who is feeling overwhelmed by investing, I really do hope to ease those feelings a little bit today. Knowledge is power when it comes to investing, and I think that's true for a lot of topics in money management. And I'll just share a quick truth about investing here. Investing does not have to be complicated to be good. So keep that in mind today as we are going throughout this webinar talking about saving and investing. Like, it really doesn't have to be complicated, and you can still be a good investor. Here's a quick quote from my favorite investing book that supports this. This is from The Simple Path to Wealth by J.L. Collins. And he says, when it comes to investing, there is nothing to lose and everything to gain by keeping things as simple as you can. So keep that in mind. If you are in the market for a good investing book or have the time to read an investing book, I do recommend that one. It's The Simple Path to Wealth by J.L. Collins. So anyway, this webinar is really meant to give you a good understanding of the basics when it comes to investing, build your confidence, and empower you to take action to make informed decisions regarding your own saving and investing. So let's take a quick look at our financial wellness ladder to kind of get an idea of where saving and investing falls on this ladder. If you have attended any of our webinars before, you've probably seen this ladder many times. At the center, we like to approach financial wellness with this ladder framework. So our financial wellness ladder is really the same as any other ladder you might climb. And there are two things I know to be true about climbing ladders. The first is that a stable base is important. We don't want our ladders to be on unstable foundations, right? And we also have to take steps on a ladder one step at a time, right? You got to climb up one rung at a time. If you just hop right up to the top of your ladder, that might not go well. You might fall off and hurt yourself. So on our ladder to financial wellness, our budget is our stable base and our foundation in financial literacy and financial wellness. And we kind of work our way up the ladder one step at a time. And honestly, it can take years to make your way up this financial wellness ladder. Today, we are talking about saving and investing, which falls on steps 2, 4, and 5 of our ladder. So creating an emergency fund on step 2, planning for the future on step 4, and growing our wealth on step 5 all require some form of saving or investing. So we're going to kind of zoom in on these few topics today. But as we go throughout the webinar, keep this ladder in mind. As we talk about saving and investing, there are some other things you might consider with your overall financial wellness in mind. Like if you don't currently have a budget or an emergency fund, well, we're going to talk about emergency funds, but if you are carrying some high interest credit card debt, for example, you might want to consider those things first. So why should we care about saving and investing? Why is it important? It's really this magic of compounding. And you've likely heard this concept before. Maybe you've heard it worded like the magic of compound interest or compound returns. Albert Einstein called compound interest the 8th wonder of the world. So that's pretty significant, right? So what is it? It is, put simply, interest on interest. And over time, it becomes really, really powerful. We'll look at a more specific example later on in the webinar, but for now, we've got this QR code on the screen here that will take you to a compound interest calculator. Sarah also just dropped a link to that compound interest calculator in the chat if you'd rather use your computer screen instead of your phone to scan this QR code. So as I'm talking here, just take a quick minute to kind of play around with this calculator. You'll be able to put things in like an initial deposit amount, a contribution amount, and how many years to let it grow. For estimated rate of return, which it's going to ask you, you might want to use something like 8% because that's the average annual rate of return in the stock market when we look at it long term. So if that already feels confusing or overwhelming, don't stress. We're going to touch on that more later. But here we just really want to get an idea of what compound returns can do for us over time. This is really like the why behind saving and investing, right? If you have thoughts as you're using this calculator, feel free to share them in the chat. If not, that's okay too. So continuing on here, why do we save? So someone said in the chat, they're saving for a trip to Iceland, I think it was, also for vacation. Some folks are saving for retirement, which is great. So we save for our personal goals, right? That's one reason why we save. Maybe we want to travel, or maybe we want to make a larger purchase like a home or a car. Maybe we even want to make a larger purchase that's kind of something fun. Like I can't think of anything off the top of my head right now, but aside from like a home or a car, maybe some sort of larger purchase that brings you joy in life. We definitely need to save for these things, right? Our emergency fund is also something that we should save for. Ideally, your emergency fund is at least 3 months of your living expenses that you have stashed away in some sort of savings account. So this is not necessarily 3 months of your income, but 3 months of your expenses. So things like your mortgage or your rent payment, utilities, food, loan payments, all the things that you have to cover on a monthly basis, you want to figure out what that number looks like, and your emergency fund goal should really be at least 3 months of those expenses. Along with maintaining a budget, having an emergency fund is another essential aspect of financial wellness. When emergencies inevitably arise and you have an emergency fund, these emergencies are no longer financial emergencies. Having an emergency fund lessens the emergency, whatever it is, by one level. Then we can also save for our periodic expenses. So I can kind of give some personal examples here. Some periodic expenses that I save for are my sewer bill, which is billed every 3 months, my car insurance, which is billed every 6 months, and also money to get my hair done every 4-ish months. Saving for your periodic expenses just involves figuring out what periodic expenses that you have. So these are expenses that come periodically, not every month. Figuring out how much you spend on each of those on an annual basis, and then dividing that annual expense by 12 so you can set some money aside for it each month. Personally, I think it feels really good to save for these periodic expenses because when these bills come out, my monthly budget doesn't have to take a huge hit. Like when my 6-month car insurance bill comes out, I don't have to drain my entire budget in that month. I can just pull out what I've been saving on a monthly basis, pay for my car insurance, and move on and not have to think about it too much. So kind of knowing that we have all of these different things that we might be saving for our personal goals, our emergency funds, and our periodic expenses, our savings accounts might end up looking something like this bucket. You might have money for your short-term goals, periodic expenses like insurance, taxes, car registration, and even gift shopping, and your emergency fund all kind of co-mingling in your savings account. Personally, I do like to break it down a little further, and I have separate savings accounts for my short-term goals, my periodic expenses, and my emergency fund, but that's totally just a personal preference. If you do decide to keep all of your monies together in one savings account, just be aware of what money is for what goal. So you've got things kind of earmarked so you know what is for what. A great place to park something like your emergency fund or any other pot of money that you don't need to access super often, but also want to keep safe, is a high yield savings account. High yield savings accounts are paying between 4 to 5% interest right now, and these are typically online accounts. So online accounts tend to pay higher interest rates, which is why these online high yield savings accounts can afford to be paying 4 to 5% interest on your savings. And this is because they don't have to pay to do things like keep the lights on and pay rent for their physical building, right? There are a lot of different companies out there that offer great high yield savings accounts. And if you don't have a high yield savings account yet, I do encourage you to make it your mission to open one. There is really no downside to having a high yield savings account. Sarah put a link in the chat where you can explore different options for high yield savings accounts and read more about what these accounts do. But if you are exploring these accounts, you should take note of the interest rate that they're offering, any minimum balances to get that interest rate or minimum balances to avoid fees, and any general fees associated with the account. I would really encourage you to look for a high yield savings account that is free to open and maintain and is FDIC insured. Annie just dropped a recommendation in the chat for a high yield savings account, Marcus by Goldman Sachs. Thanks for the recommendation, the tip. That's actually the one that I have, and it served me well over the last few years. But there are tons of options out there. So do your research, right? Make sure it's free. You don't want to have to pay to save your money. Make sure it's FDIC insured as well. There are also money market accounts, which are actually pretty similar to high yield savings accounts, but money market accounts typically have minimum balance requirements and also come with the ability to write checks or sometimes use a debit card linked directly to the account. So there are lots of options out here for ways that you can save your money. And when it comes to your savings, I'll just say, I think the worst thing you can do is keep all of your money in your checking account because first you'll have access to it all, so it'll make it really easy to spend, and it won't be earning you much, if any, interest. Most savings accounts do earn interest of some kind, and we really do want our money to be working for us wherever possible, right? Okay, so we talked a bit about saving. Now we've graduated to rung 4 of our financial wellness ladder, which is to plan for the future. So as you are kind of taking a minute to look at this ladder again, remember that budgeting is our stable base and our foundation in financial wellness, and an emergency fund is almost equally as important as having a budget. From there, considering your debt is an important next step. Any high interest debt should really be prioritized once you've got a good budget and a solid emergency fund. From there, then, we're in this space where we are planning for the future. Planning for the future is going to look different for us all, but when you think of planning for the future, you might think of these sorts of things, maybe retirement, marriage, children, home buying, wealth building. And if these are long-term goals, we must invest for them. Yikes, I hope no one was sleeping. Because of inflation, saving for these goals is not enough. So here I just want to take a minute. I'm seeing the laugh reaction. I'm glad you enjoyed that. Here, let's just take a quick minute to address the difference between saving and investing. So when we save, we're putting our money into some sort of savings vehicle like a savings account. Our money is really safe and secure as long as our accounts are FDIC insured. Safe is good, but when we save, our money doesn't earn much money for us. 4 to 5% interest in a high yield savings account or maybe a CD, certificate of deposit, is going to be about the most you can earn on your savings right now. The plus side, though, with saving is that your money will be 100% there for you when you need it. When we invest our money, it is riskier because we're subjecting our money to the market, and the market is volatile. But investing can also come with a higher return when done properly. So when we invest long-term, our money can earn anywhere from 8 to 12% on average annually. If we save long-term, we'll likely end up losing money because of the impact that inflation has on cash. So this QR code on the screen here, or the link that Sarah just dropped in the chat, will take you to an inflation calculator that you can kind of use to see this for yourself. You can play around with this and maybe put in like your current savings that you have to kind of see what inflation will do to those savings. As you play around with this, as you look at this, you might be wondering then, does it ever make sense to save versus invest? Like, why would I save if my money is losing money? But we do want our emergency funds to be saved, right? And the high yield savings accounts can kind of help to combat inflation a little bit. If you have short-term financial goals, you will also likely want to save that money rather than invest it. And you should really let your goal for your money and your own personal risk tolerance guide whether you save your money or invest your money. So a good guiding light to kind of help you get started in thinking about this is the 5 to 7 year rule. Experts suggest that if your goal for your money is less than 5 years away, you might want to save that money to keep it safe and secure. And if your goal for your money is more than 7 years away, you might want to invest that money to take advantage of the compound growth that the market can offer. That 5 to 7 year space would kind of be the gray area where you really have to rely on your own personal risk tolerance to help you decide, should I save or should I invest? So for example, if you are saving for a car that you want to buy in 5 years, you'd likely want to save that in something like a high yield savings account or a certificate of deposit to keep your money safe and secure. On the other hand, if you are saving for a house that you hope to buy in 10 years, you might invest that money to take advantage of the compound returns that come when you invest in the market. At the same time, if you're saving for that house in 10 years and you're a really risk-averse person, you might still save it rather than invest it, especially if investing it would kind of keep you up at night. But to kind of answer the question at the top of the slide here, will saving be enough? Unfortunately, saving will not be enough when it comes to retirement, especially. We really have to get comfortable investing our funds for retirement because it is absolutely necessary. I'm going to take a quick look at the chat here before we move on to the next slide because I see some good questions. The FDIC only insures up to 250,000, right? That is right. Yes. 250,000 per account. So if you're lucky enough to have more than $250,000 that you have saved, you can break it up into multiple different bank accounts, and those chunks of money would be insured. But if you have more than 250,000 and it's not allocated to a specific goal, you might want to think about investing that money, right? Another question, do you get charged for taking money out of your high yield savings account in several years? It's going to depend on the account, probably. You shouldn't get charged for taking money out of your high yield savings account ever. The one that I have and the link that Sarah shared with a lot of good recommendations for high yield savings accounts from NerdWallet, likely you're not going to get charged for taking money out of any of those. Where you might get charged, though, you will get charged is the tax that your high yield savings account earns. Or I'm sorry, you'll get charged tax on the earnings that your high yield savings account earns. So that's something to be aware of. Good questions, good questions. Okay, so let's take a look at what building wealth for retirement could look like here. And I think in our audience, it seems like we've got people from all different ages and stages of life. So don't get discouraged by this example if you're already closer to retirement. But let's take a look here. So we've got 3 people. First, we have Talia. She begins investing at age 35. She decides to invest $5,000 a year from age 35 to age 65. So Talia has invested for 30 years here. She's invested a total of $150,000 of her own money. Next, we have Jess. Jess begins investing at age 25. She's also investing $5,000 a year. But something happens to Jess at age 35. Maybe her life gets really crazy and she has twins or something. Who knows? So she's only invested for 10 years and she has invested a total of $50,000 of her own money. Nate then also begins investing at age 25. He invests $5,000 a year every single year. He doesn't stop at age 35, but he continues on to age 65. So Nate has invested for a total of 40 years and has contributed $200,000 of his own money towards his investments. So I want to share out a poll here. I'm really curious to see who you think will have the biggest nest egg in retirement. I'm going to launch out this poll. I've got 3 questions. I'm kind of asking you to rank like who will have the most, who will have the second highest and who will have the least. So take a minute to think about this here. Okay, it looks like things have stopped moving around. So I'm gonna share this out so you can see what other people thought as well. So most of us think that Nate is going to have the most money in retirement. And a few of us said Talia, which maybe the color of the line there was kind of confusing. So let's take a look. Who's on top? Nate comes out on top at age 65. He has over $1 million, which is great. Who's next, though? I think this one's a little tricky. Most of us thought that Talia would come out next, but it's actually Jess. And Talia comes out on the bottom. So Jess has about 600,000. Talia has a little less with 540,000. And I wanted to kind of get you thinking about what this could look like, especially for you younger folks in the audience. So when I look at an example like this, like seeing that Jess has only invested $50,000 and she still comes out above Talia, who has invested $150,000, but started 10 years later. Examples like this just continue to surprise me and kind of knock my socks off, even though I live and breathe and work in this financial literacy space. But this is a realistic example. This is the magic and power of compound returns and starting young. So when we think about compound interest and compound returns, a big piece of that is the time that you have for your money to grow and compound and just kind of collect all of this free money along the way. So let's talk about this return in the market for a minute. This example is using a yearly return of about 8%, which is totally reasonable. I do want to highlight, though, that this doesn't mean that your money will earn 8% each year when you invest, like it would in maybe a savings account. Not that it would earn 8%, but if your savings account is advertising 5%, you can expect to see that each year. Investing is not like that. So 8% is more of an average expectation of what your annual returns could likely average out to be. So maybe one year you earn 6%, one year you earn -4%, the next year you earn -3%, and then the next year you earn 20%. When you kind of zoom out and look at your returns over time, you'll likely see returns of about 8 to 10% annually based on history, but just don't get that confused. You're not going to see that every single year when you invest money because the market is volatile, right? But again, this example here is kind of the why behind it all, right? The magic of compounding, and we really want to be investing as early and often as possible. So when it comes to planning for retirement, or planning for the future, the biggest expense that I think we need to think about here is retirement. This is something that we all will need to plan for, no matter what we do or who we are or how much money we have or make. We all need to think about retirement. So when you have access to an employer-sponsored retirement plan, that's usually the best place to start with your retirement savings because it oftentimes comes with an employer match. If you work here at Penn State, I know we have a lot of staff members in our audience today, and you use the 403B defined contribution retirement plan, when you contribute 5% of your salary, Penn State contributes 9.29% of your salary. Through the one-on-one financial coaching program, I've sat down with a lot of students and looked at their benefits packages to kind of help them understand and figure out what these things all mean. So I've seen a lot of benefits packages, and this is one of the best matching programs that I have ever seen. So thank you, Penn State. We appreciate this. An example of a simple match would be if you contribute 5% of your salary, your employer also contributes 5% of your salary into your retirement account. A good rule of thumb here is to always, always, always contribute enough to take advantage of that full employer match. So if your company is matching 10%, you better be putting in 10% to your retirement. A 401k or a 403b typically follows the traditional taxing system. So usually with these employer-sponsored retirement accounts, you contribute money pre-tax. That lowers your taxable income for that year, and then you pay tax on that money when you take it out in retirement. So you can kind of think of this as having to pay yourself a gross salary in retirement, which will then be taxed to arrive at your net salary in retirement. I have also seen some companies start to offer Roth 401ks as well, which is really interesting. That's something that's new and different. We'll talk about the difference between Roth and traditional in just a second. But a 401k or a 403b is known as a defined contribution plan. This is because what you contribute is consistent, but the benefit that you receive in retirement will not be consistent. It'll be based on how much you contribute and how your investments perform. A pension is also known as a defined benefit plan because it's kind of the opposite. The benefit that you receive in retirement is consistent with a pension. Pensions are kind of slowly but surely becoming a thing of the past. Penn State currently offers a hybrid plan, which is a combination of the two plans. So part of it's pension and part of it is the defined contribution plan. So anyway, once you've taken advantage of your 401k or 403b employer match, if you want to continue investing for retirement, or maybe you're a student who doesn't have access to an employer-sponsored retirement account right now, this is where the IRA comes in. IRA stands for Individual Retirement Account. So this is something that you manage completely on your own, separate from any employer-sponsored retirement account that you have. This is really money that is to be earmarked for retirement. So it's meant to be drawn from after age 59 and a half. There are traditional IRAs and Roth IRAs, and the main difference between these accounts, the traditional and the Roth, is how they are taxed. There are some exceptions, and there are some times that you can take money out of your IRA before age 59 and a half. Typically, if you withdraw before age 59 and a half without a proper exception, you'll be subject to a 10% penalty and have to pay taxes on that money in many cases. But one of the things that you can withdraw for early is to buy a first home. And I'll have Sarah pop a link in the chat here with more information on how you can go about that and what that could look like if you'd like to read up more on that. So the Roth IRA can really be a powerful investing tool, and we've got a short video here to kind of help explain the specific differences between the Roth and the traditional IRA.
Roth IRAs. Roth IRAs are retirement savings accounts with big benefits. Here's how saving in a Roth IRA works. First, you open an account. Then you contribute after-tax money to the account, such as money you're transferring from your bank account. Your money grows tax-free over time while it's invested in your Roth IRA, and eventually you can withdraw the money tax-free once you're in retirement. Roth IRAs can come with some special added benefits. You can withdraw your contributions penalty-free anytime. You can use the funds in your account for a first-time home purchase without paying withdrawal penalties. And you're likely to have many investment choices with a Roth IRA. The main difference between traditional IRAs and Roth IRAs is when you pay taxes. With a traditional IRA, you contribute pre-tax money directly from your paycheck. Your money grows tax-deferred, and you then pay taxes on withdrawals and retirement. With a Roth IRA, you contribute after-tax money, your money grows tax-free, and you pay no taxes on withdrawals and retirement. Because they let you get your taxes out of the way today, Roth IRAs can be a great choice if you're in a low tax bracket now and maybe in a higher one in retirement. Whether it's the only account you use or just one of a number of retirement accounts, a Roth IRA can bring some important advantages to your retirement planning.
Okay, hopefully that short video there was kind of helpful in thinking about the difference between traditional and Roth IRAs and kind of how they're taxed, how they work. I just want to quickly touch on here when you might invest into a traditional IRA or a Roth IRA. Like, when in your stage of life would one versus the other make the most sense? And you really, because it's based on tax, you kind of have to think about where you are in your career where you are in your career, and also like your future potential, your future earning potential. So if you are someone who is young in their career, not making as much as they're eventually going to be making, you might want to invest in your Roth IRA because you're paying low tax now compared to what you'll be paying in the future when you're making more money in a higher tax bracket. On the other hand, if you are someone who is in the peak earning years of your career, you might benefit from investing into your traditional IRA rather than your Roth IRA because you're paying higher tax at that point, and your traditional IRA is also going to lower your taxable income in that year. So you kind of have to just think about the money that you're making now versus what you might be making in the future and that earning potential, and that can kind of help guide that decision there. So now we have kind of graduated to the fifth and final rung of our financial wellness ladder, where we are really focusing on growing our wealth. Building and growing our wealth does require investing of some kind. We know that saving is not enough to grow our wealth, so we'll talk about investing outside of retirement accounts next. But I do want to say the core concepts of investing that we're about to talk about are going to be the same whether you are investing in your IRA for retirement or your taxable brokerage account to build wealth. So you can apply what we learn in this next segment to investing in your IRA or your 401k or 403b or a general brokerage account. Question. This is a good question. If you're someone young starting a Roth, but will be in a higher tax bracket, do you switch from Roth to traditional later or always keep a Roth? You can do both. So if you open a Roth right off the bat, you definitely want to keep that and manage that. But later on, when you decide like, okay, I'm kind of in my peak earning years, it doesn't make much sense right now to invest into my Roth. You can open a traditional IRA at that point and just put some money in there until things change for you again, if they do change. I also will highlight there are some income exemptions for the Roth IRA, like phase outs, I guess I want to call them. Off the top of my head, I do not know the numbers, but if you make over a certain amount, either as a couple filing jointly or a single person filing singly, you are no longer eligible for the Roth IRA. So there's that as well. And at that point, you might want to utilize your traditional IRA. Thank you, Sarah. Appreciate it. Okay, so beginning to invest outside of your retirement accounts could feel overwhelming because you have a lot of choices, but it really doesn't have to be. And choices are good. So the first thing you want to figure out here is how much you're going to invest. Will you invest regularly on a monthly basis? Like, what does that look like for you? Have you fit it into your budget? From there, you'll open an investment account. There are many options for investment accounts, and we'll talk about those more on the next slide. But oftentimes, a brokerage account or a robo-advising account is a good choice. Once you've opened your account, you'll choose your investment mix, or basically, you'll just choose what investments you want and you'll purchase them if necessary. Then you'll change your investments over time. That can really be as infrequently as one time per year, especially when you're investing for your long-term goals. So let's take a look here at the different investment accounts available. So here are some options for investment accounts. You can open a brokerage account, you can work with a financial advisor, or you can utilize a robo-advisor. When it comes to brokerage accounts, there are full service brokers and discount brokerages. The two most cost-effective and accessible of these investment accounts are discount brokerages and robo-advising accounts. If you are ever at a point where you've got hundreds of thousands of dollars to manage in your portfolio and it feels like a little bit too much to manage yourself, you might at that point work with a financial advisor. But if you're a newer investor and are maybe working with a few hundred or even a few $1,000s, deciding between a brokerage account and a robo-advising account is a really good place to start. With a robo-advising account, when you go to sign up for the account, they will ask you some questions like what you're investing for, when you need the money that you're investing, and how you personally feel about risk. With this information, they will actually go and build you your own personalized portfolio composed of a certain percentage of stocks and a certain percentage of bonds. And anytime you put money into that account, it will be automatically invested for you according to how you answered those questions when you first signed up for your account. If you think you'd be comfortable choosing your own investments within your investing account, a discount brokerage might be best for you. With this type of account, you fund the account by putting money into it, and then you actually have to go in and decide what you'd like to invest in and purchase those investments. So we've got some examples for each of these types of accounts in the chat if you'd like to kind of explore what companies offer these accounts and where might I get started with either of these. Another type of investing vehicle that you might think about if you have children who plan to go to college or hope to have children in the future are 529 college savings accounts or programs. So there is this program called the Keystone Scholars, and under this program, all children born in 2019 and after to Pennsylvania residents have a Keystone Scholars account in their name with $100 funded for post-secondary education expenses. The Keystone Scholars $100 starter deposit is held in a custodial account within the PA 529 Guaranteed Savings Plan, and it's invested by the Pennsylvania Treasury. Its growth is based on a historical average of tuition inflation at the Pennsylvania State System of Higher Education. So the fundamental concept of the Pennsylvania 529 GSP or Guaranteed Savings Plan is that if you save enough for post-secondary tuition today, whether that is just one credit, a full semester, or a full 4 years, you will have enough to cover that amount of tuition at that level in the future, no matter when or how much tuition has gone up between the time that you invested and signed up to the point where you're using that money. There are also 529 investment plans, and these are tax-advantaged accounts where you can invest money for children's college and education expenses. So the benefit that you receive through a 529 investment plan is really going to depend on how much is invested into that account and how those investments perform. There is a link in the chat here with more information on 529 accounts if this is something that you are interested in or thinking about at this point. Okay, so when we talk about choosing our own investments or choosing our investment mix, here are some options for things that you could be choosing from. So bonds, real estate, stocks, or alternative investments are all things that you might think about investing in. And we'll kind of unpack each of these and give you the basics behind them. Starting with bonds. So when you buy a bond, you're actually loaning money to a government or a corporation. The organization pays you to lend them money. So for example, if your local city needs to build a new bridge but doesn't have the cash on hand to do so, they might issue bonds to raise money. The people who buy those bonds are lending the city money to build that bridge. The city will pay these folks regularly based on the interest rate that was agreed upon in the bond terms. And then when the bond matures, the city will pay back that initial investment to the investors. Bonds are usually less risky, but there's a rating system to help determine the risk of each specific bond. The fixed returns that come with bonds can be helpful for planning purposes. Like if you are someone who is in retirement already and is trying to make plans with your money, those fixed returns might be helpful. Drawbacks with bonds are that because they are typically less risky, they also typically provide lower returns. Rising interest rates can decrease bond values. And if you invest into corporate bonds, there could be risk for default. So you've got to check out those bond ratings before investing into a bond. There are also, though, bond funds that can be invested in through platforms like brokerage accounts and robo-advising accounts. And bonds can give investors, bond funds can give investors easier access to bonds. So as we go through these different investment options, you'll see the risk meter down on the bottom right of the slide here. So be sure to check that out for each of these options. Bonds are typically low risk. Moving on to real estate, the two main ways that you can make money investing in real estate are from the home or the property appreciating in value or through rental homes or rental properties. Investing in real estate can take a lot of planning and money down. So REITs or real estate investment trusts can give investors easier access to real estate investments. When you invest into a REIT, you are really investing in companies that own or finance income-producing real estate across a broad range of property sectors. So you might see residential properties, commercial properties, that kind of thing. Pros of REITs include they're much more liquid than owning actual property. Like you can sell off your REIT and have your money pretty immediately, whereas if you own actual property, you're going to have to go through the home selling process, which can take some time. REITs can add diversification to your portfolio, which is always a good thing. Cons of REITs include the current high interest rate environment can decrease property and REIT values, and they can be harder to value and can be research intensive. So check out our risk meter here for this one. Real estate and REITs typically are medium risk investments. Moving on to stocks here, I think stocks are what we tend to think about when we think about investing. When you own a stock, you own part of a company. So if you buy a share of Apple, you own a tiny little piece of Apple. You are part owner of that company. There are two ways to earn money when investing in stocks. Price appreciation, so the stock value goes up, and also dividends, which is money that the company pays out to their shareholders. It's important to note that not all companies pay dividends. Positives for stocks include that they typically have higher returns. An 8% averaged annualized return can be typical. And they're easy to get access to because you can buy fractional shares. So if you want to buy Apple, for example, and you don't have $170 to purchase Apple, you can buy a piece of a share. Cons of investing into stocks include that they're higher risk. They're also research intensive. So putting in all the research to find the perfect company for you to invest in will be time consuming, to say the least. And stocks are also volatile, meaning that their prices can fluctuate a lot. So investing in stocks can be an emotional roller coaster. Check out our risk meter here. Stocks are high risk. But there is a way that we can invest into stocks without having to do a lot of time-consuming research and put all this effort and energy into constructing our own portfolios. And we can do this all while decreasing our risk, so bumping that risk meter down to the left a little bit, and also diversifying our funds. So let's talk about mutual funds here. And we have a fun example here to explain this concept. So kind of recapping what I said earlier, stocks are one of the most popular types of investments, and they're also a great way to build your wealth and invest for retirement. With that said, the cons associated with investing into stocks are also big and important things to consider. It's high risk, right? So unless you are the CEO of the company, you don't really have any idea of what the company is up to or any say if the stock price is going to go up or down. And like I said earlier, it can be an emotional roller coaster. Something could happen in the world or on the news, and the company that was once doing well and getting great returns could have taken a huge financial loss or now be bankrupt potentially. So really trying to understand what's going on in one company will be difficult, let alone trying to understand what's going on in multiple companies as you try and piece together a portfolio for yourself. But there is another way here. And we use a fun example to explain this concept. It's sushi. So hopefully everyone has had sushi before. So like individual stocks, sushi is a really great food and it's fun to eat, right? Love me some sushi. But has anyone ever tried to make sushi? I haven't, but I would think that it would be quite complex to figure it out. You know, you'll have to try to find the right base, the right rice, figuring out what you even want on your sushi roll, tracking down those ingredients in the grocery store, picking those things out, cooking everything perfectly, figuring out how to do the roll, all of those things. Sounds a bit overwhelming, right? Another option, an easier option, is to go to a restaurant and have a professional sushi chef prepare your sushi for you. This will be easier and simpler. They're trained professionals who know what they're doing, and they've done this hundreds of times. You can eat sushi this way, and you'll likely have a very pleasant experience. It will be simple, less overwhelming, tasty. It'll be great. So when we think about stocks, it's kind of the same thing. You know, you can try to compare different stocks to build your own portfolio. You know, you can look at different sectors, tech stocks, construction stocks, consumer stocks, small cap, large cap, medium cap. You can do the research, you know, research the company and look at the financials and kind of build your own portfolio. It is technically possible to do this, but it would definitely be time consuming, probably overwhelming, and it would likely not give you the best possible result. So that's one option. Or you can allow things like mutual funds, index funds, and exchange traded funds work for you. The concept behind these investing options is that when you buy one share, you're actually buying a bunch of different companies when you buy just one share. They are baskets of securities, and they can be passively managed or actively managed. Index funds, if you've heard of index funds, are passively managed. They just follow an index that already exists. For this reason, index fund investing tends to be very cost effective. An index fund that you might have heard of is the S&P 500. It's made up of the 500 largest companies in the United States. So you can actually invest into the S&P 500 by investing into an S&P 500 index fund. And this is just one example. There are many different index funds, indexes and index funds out there that you can choose from. So when you are comparing mutual funds, index funds, or exchange traded funds, be sure to take note of the expense ratio. This is an important piece of investing. And the expense ratio is really just the cost per year to invest into the fund. It's expressed as a percentage of the money that you have invested. So, quick crash course on mutual funds, index funds, exchange traded funds. There is more information in the chat if you'd like to read up on this a little further. So lastly, we have alternative investments. These are things like cryptocurrency, NFTs, collectibles, commodities, or even new business ventures. Pros of alternative investments include that they have the potential for great returns. They add diversification to your portfolio, but they do come with very high risk as well. They also have less regulation and reporting requirements and can be complex and expensive. So naturally, they're going to be on the red in our risk meter. They are very risky, right? So how can we kind of put all of these things together to create a diversified portfolio for ourselves? Remember that you've got to think about your goal and your time horizon. Or your time horizon is the time that the money can be invested until you need it. Your goal should really help you determine that. So the longer the amount of time that you have until you need your money, the more risky that you can afford to be with your investments. So here are some different portfolio options or some different ways you might invest based on your goal and your personal risk tolerance. So a conservative portfolio, a moderately conservative portfolio, moderate, moderately aggressive, and aggressive. So some things I notice here as we go farther towards the aggressive side is that we've got more stocks and less bonds and cash in our portfolios. There is a link in the chat, and also the QR code will take you to an investor questionnaire that can kind of help you determine what your investment mix should look like based on your goals and your personal risk tolerance. This will at least might not be perfectly accurate, but it'll give you a good starting place and kind of help give you a guide on how you might think about this. So that was the official end of today's webinar. I do know this was a lot of information, but I want to stress our office is really here to help, and we can continue this conversation with you through some of our other services. All of our services are free and available to currently enrolled Penn State students, and some of our services are available to alumni, faculty, and staff. We have partnered with PNC to offer financial literacy appointments to faculty and staff. We don't take those on ourselves, but there is some good information in the chat here. So if you'd like to schedule a one-on-one, no matter who you are, you can use the information in the chat to help you schedule that. There's a link to our YouTube page. All of our webinars are recorded and posted on our YouTube page shortly after the session itself. We also have our Saving and Investing self-study module linked in the chat there. You can find all of our services at our website, which is financialliteracy.psu.edu.